Most people believe that institutions like BlackRock are immune to collapse. They've retold over and over again that the company managing more than $8 trillion is simply too sophisticated, too diversified, and too connected to fail. But the truth emerging behind closed doors is far more disturbing. What if the very institution designed to stabilize financial markets is now unintentionally destabilizing them? What if the largest asset manager on earth integrated into governments, banks, and corporations is quietly triggering a chain reaction of stress spreading through the global financial system? And what if the banks now in serious trouble aren't collapsing by accident, but because of structural weaknesses tied directly back to BlackRock's growing vulnerabilities? These questions might sound dramatic, but every major financial crisis in history began with someone asking questions, just like these questions ignored until it was too late. Today's story is the same, except this time, the system is far more interconnected, far more leveraged, and far more dependent on a single giant than ever before. BlackRock's recent signals, warnings, portfolio stresses, liquidity challenges, and exposure to high-risk markets have quietly set off alarms among insiders, and yet the public remains unaware that a collapse in confidence at BlackRock would not be an isolated event. It would ignite a global shockwave across banks, markets, and entire economies. To understand why this moment feels eerily familiar, we must rewind to the origins of BlackRock. In the late 1980s, Larry Fink, a bond trader who suffered a massive trading loss, became obsessed with risk management. That obsession led to the creation of BlackRock, a firm built not on flashy trading but on technology, modeling, and systematic analysis. Over time, BlackRock expanded far beyond anyone's expectations. It created Aladdin, a risk system so powerful that not only but also major banks, hedge funds, insurers, and even government institutions rely on it to evaluate trillions of dollars of assets. The company pioneered passive investing, pushing low-cost index funds and ETFs that attracted trillions in client money. It expanded into real estate, infrastructure, private credit, and emerging markets. It advised governments during it became a force in Washington, Brussels, London, and Beijing. It grew into the single largest shareholder in many Fortune 500 companies. The rise was smooth, relentless, and almost invisible to the general public. By the time anyone realized how powerful BlackRock had become, it was already essential to the global economic system. The roots of the present crisis trace back to the era of ultra-low interest rates. For more than a decade, borrowing was essentially free. This environment created a frenzy of risk-taking, expansion, and overconfidence. Corporations issued cheap debt, banks lent freely. Investors chased yield, and asset managers like BlackRock expanded into products promising higher returns in a low-return world. One of the fastest-growing markets was private credit, a shadow banking system where funds, not banks, lend money to companies that often cannot qualify for traditional bank loans. BlackRock embraced it, seeing massive opportunity. For years, it worked flawlessly. The system ballooned from a few $100 billion to more than $2 trillion. Yet beneath the surface, something dangerous was forming. Borrowers who relied on cheap money were locking in loans that would become deadly burdens once rates rose. When inflation surged unexpectedly, central banks responded with the fastest rate hikes in modern history. This was a spark that revealed how fragile the system had become, and it exposed the first cracks in BlackRock's portfolio. Long-duration assets like government bonds plunged in value, causing unrealized losses across funds. Commercial real estate loans began deteriorating as remote work hollowed out office demand. High-risk borrowers in private credit struggled under soaring interest payments. The assumption that private loans were safe because they weren't publicly traded turned out to be false defaults, began rising quietly behind the scenes. Banks started tightening lending, especially in commercial and industrial sectors. The same companies relying on BlackRock's private credit funds suddenly couldn't refinance their debts, and the cycle began. The chain reaction grew because BlackRock is not merely a participant in markets, it is a central node. When BlackRock funds experienced stress, they were forced to sell assets. When prices fell, banks holding similar assets saw their capital ratios shrink. As banks' balance sheets weakened, they tightened credit even further. This hurt borrowers. Struggling borrowers missed payments. Those missed payments hurt BlackRock's private funds. Insiders began noticing that the cracks weren't isolated, they were connected, amplified by the scale of BlackRock's holdings. BlackRock didn't cause the stress alone, but its size ensured that once stress appeared, it spread rapidly. The rise of concern became unavoidable when internal assessments and warnings began circulating. BlackRock issued subtle alerts in quarterly letters, earnings calls, and private client briefings. The language was measured, technical, and careful, but the underlying message was unmistakable. Liquidity was thinning. Private credit risks were rising, and real estate valuations were overstated. The second wave of warnings was less subtle. It acknowledged that refinancing risks were worse than expected, that more companies were showing signs of distress, and that global markets were entering what BlackRock called a regime of persistent instability. While the public barely noticed these warnings, banks didn't. They responded by tightening even further, relying even more heavily on internal models that, ironically, were often built on BlackRock's own Aladdin system. The breaking point came when several banks revealed losses tied to commercial real estate and private credit exposures. These losses were not catastrophic on their own, but they revealed a frightening truth. Many banks and BlackRock were exposed to the same struggling borrowers. The diversification that was supposed to protect the system had actually connected it more tightly. A default on a major commercial building loan hit the bank that funded the mortgage, the pension fund that invested in the building, and the BlackRock fund that held the securities all simultaneously. The market realized this wasn't a series of independent failures. European banks faced liquidity shortages due to falling bond values. U.S. regional banks, already weakened from earlier crises, saw renewed pressure as deposit flows shifted. BlackRock's ETFs experienced outflows, forcing additional asset sales at unfavorable prices. Pension funds depending on high returns from private credit reported deteriorating valuations. Even sovereign wealth funds reduced their exposure, signaling that the world's deepest pools of capital no longer trusted the stability of certain markets. But the scariest consequence was the loss of liquidity. Financial markets run on liquidity. When liquidity dries up, markets seize, funding evaporates, and companies fail not because they are unprofitable, but because they cannot access cash. BlackRock attempted multiple strategies to stabilize its funds, reassured investors, and prevent forced selling. It tried shifting its portfolios toward higher quality assets, but the transition caused temporary volatility that worsened performance. It attempted to negotiate restructuring terms with struggling borrowers, but many companies were beyond saving. It sought to raise new capital for private credit funds to buy time, but investor appetite had shrunk. Even internal stress models revealed that the system would struggle under continued tight monetary policy. None of these moves were enough because the problem was larger than BlackRock. The entire financial system had been built around the assumption of low rates, cheap credit, and endless liquidity. Once these disappeared, the system couldn't adjust smoothly. The modern parallels became chilling. In 2008, the crisis began with subprime mortgages mall failures that spread through a network of securitized products. Today, the failures begin in private credit-opaque loans spreading through a network of funds, banks, CLOs, and private markets. Today, commercial buildings, private companies, and leveraged borrowers carry valuations detached from reality. In 2020, the market froze until central banks intervened with unlimited liquidity. Every historical crisis rhymes with today, but this time, the system is more interconnected, more leveraged, and more dependent on BlackRock than ever before. The data emerging now points to a dark trajectory. Corporate bankruptcies accelerating faster than during 2008. Private credit defaults rising at double-digit rates. Commercial real estate vacancies hitting record highs. Office loan delinquencies climbing. Bank lending tightening at the fastest rate in decades. And global liquidity declining quarter after quarter. These are not normal fluctuations. They are signs of systemic decline. And because BlackRock sits at the center of these markets, the impact radiates outward like expanding shockwaves. The chain reaction triggered by BlackRock's vulnerabilities has profound implications for ordinary people. When credit dries up, companies lay off workers. When markets fall, consumer confidence collapses. The average household experiences the chain reaction indirectly, but powerfully higher prices, lower wages, shrinking savings, and fewer opportunities. Despite the severity of this situation, many people remain unaware because there has not been a dramatic, headline-grabbing collapse. No Lehman Brothers, no Bear Stearns, New Sudan implosion. Instead, this crisis behaves like erosion, slow, silent, and destructive. But erosion eventually becomes a landslide. The financial system can endure stress, but it cannot endure declining liquidity. BlackRock's position magnifies all of these because As the largest asset manager, its movements influence the movements of others. There are three fundamental takeaways from this unfolding crisis. BlackRock's dominance was a strength during stable periods, but during stress, it becomes a vulnerability for everyone. Second, private credit is not the quiet, it is the epicenter of hidden risks that will reshape global markets. The warning is straightforward but urgent. Do not assume this crisis will resolve itself. Financial systems do not correct smoothly when leverage, opacity, and interconnectedness reach critical levels, and which attempt to hide the truth. And the open question the one regulators quietly fear is whether the chain reaction has already progressed too far to contain what banks won't publicly admit and what BlackRock signals really mean. Then make sure you subscribe, like this video, and share it with someone who needs to understand the reality of today's financial landscape. The storm is developing whether we acknowledge it or not, but the people who stay informed, who prepare early are always the ones who make it through the turbulence ahead.